Next, I will discuss Astro's vision. Astro's vision is to be Malaysia's #1 entertainment destination. This vision reflects the company's long-term goal of remaining the leading entertainment provider in Malaysia. It is clear, simple, and easy for stakeholders to understand, while providing direction for the company's strategic decision and growth. One of the strengths of this vision is that it emphasizes market leadership and supports Astro's efforts in improving customer experience through digital platforms such as Astro Go, Suka, and Astro Fiber. These initiatives help Astro stand competitive in the rapidly changing media industry. However, the vision could be strengthened by including elements of innovation, digital transformation, and sustainability. Now I will explain Astro's mission. Astro's mission is we will deliver our vision through captivating content products and experiences enhanced with modernized technology and superior team. This mission explains how Astro plans to achieve its vision by focusing on quality content, advanced technology, excellent customer experiences, and talented employees. A key strength of this mission is that it highlights the most important of both technology and human capital in maintaining Astro's competitiveness. It also aligns with current industry trends where continuous innovation is essential to meet changing customer preferences and compete with global streaming services. However, the mission could place greater emphasis on sustainability and value creation for stakeholders. Therefore, we propose the revised mission to deliver exceptional entertainment experiences through innovative content, advanced technology, and talented people while creating sustainable value for customers, employees, communities, and shareholders. This vision better reflects Astro's commitment to long-term growth and responsible business practices. Next, I will present the SWOT analysis of Astro Malaysia Holding Berhad. Starting with strengths, Astro is Malaysia's leading entertainment company with a strong brand reputation, a large customer base, and a diverse range of services, including pay TV, streaming, radio, and broadband. The company also has a strong local content production capabilities and continues to invest in digital technology. Moving on to weaknesses, Astro relies heavily on the Malaysian market and has experienced a decline in traditional pay TV subscribers due to the growing popularity of streaming services. In addition, content acquisition and technology investments involve high operating costs. For opportunities, Astro can benefit from the increasing demand for streaming and on-demand content, the growth of internet usage, and the expansion of digital advertising. The company can also strengthen its position through strategic partnerships and innovative digital services. Lastly, the main threats include intense competition from global streaming platforms such as Netflix and Disney+, content piracy, changing consumer preferences, and rapid technological advancements. In conclusion, Astro has a strong competitive advantages and significant growth opportunities, but it must continue innovating and adapting to industry changes to maintain its leadership position in Malaysia's entertainment industry.
Next, I will present the internal factor evaluation or IFE matrix. So, the IFE matrix is used to evaluate Astro's internal strength and weaknesses. Based on our analysis, Astro achieved a total weighted score of 3.33, which is above the benchmark score of 2.5. So, this indicates that Astro has a strong internal position. Its main strengths include strong brand recognition, a large customer base, diversified business operations, strong local content production capabilities, and a comprehensive digital entertainment ecosystem. However, Astro still faces several weaknesses such as declining pay TV subscriptions, dependence on the Malaysian market, high content acquisition costs, and limited international exposure. Overall, Astro is effectively leveraging its strengths, but it should continue expanding its digital business and diversify its revenue sources to remain competitive. Moving on to the external factor evaluation of EFE matrix. So the EFE matrix evaluates how effectively Astro responds to external opportunities and threats. Astro obtained a total weighted score of 3.11, which is also above the benchmark score of 2.5. This shows that Astro is responding well to changes in its external environment. Key opportunities include the growth of streaming services, broadband expansion, increasing demand for local content, and strategic partnerships. On the other hand, Astro faces threats such as intense competition from global streaming platforms, content piracy, rising licensing costs, and changing consumer preferences. In conclusion, Astro has successfully capitalized on industry opportunities, but continuous innovation and digital transformation are needed to sustain its competitive advantage. Next is the competitive profile matrix, or CPM. The CPM compares Astro with its main competitors, which are Netflix and Disney Plus Hotstar. Based on the analysis, Astro achieved the highest score of 3.82, followed by Netflix with 3.68, and Disney Plus Hotstar is 3.50. This indicates that Astro remains highly competitive in the Malaysian entertainment industry. Its competitive advantages include strong local content production, a large customer base, strong brand reputation, and an integrated ecosystem consisting of pay TV, streaming platforms, radio broadcasting, and broadband services. Although Netflix and Disney Plus have strong global content libraries and advanced technologies, Astro maintains an advantage through its deep understanding of local consumer preferences. After analyzing Astro's internal and external environment through the IFE, EFE, and CPM analyzers in Chapter 2, the next step is to formulate appropriate strategies for the company. Therefore, Chapter 3 focuses on strategic formulation by using the IE matrix and BCG matrix to determine Astro's strategic position and identify suitable growth strategies for future development. Firstly, we use the internal, external, or IE matrix. This matrix combines the IFE and EFE scores to determine the company's overall strategic position. Based on Astro's IFE score of 3.23 and EFE score of 3.11, Astro is positioned in Cell 1, which represents the grow and build quadrant. This position indicates that Astro has strong internal capabilities and is effectively responding to external opportunities and threats. Therefore, Astro should pursue aggressive growth strategies such as market penetration, market development, product development, and strategic alliances to strengthen its market leadership. Besides understanding Astro's overall strategic position, it is also important to evaluate the performance of its business segments. Therefore, the BCG matrix was used to analyze Astro's business portfolio based on market growth rate and relative market share. The BCG matrix classifies business segments into 4 categories: stars, cash, cows, question mark, and dogs. Based on our analysis, Astrogo and Suka are categorized as stars because they operate in high growth market and have strong growth potential. Therefore, Astro should continue investing in these platforms to strengthen its position in the digital entertainment industry. Meanwhile, Astro's pay TV services are classified as cash cows. Although the market growth is relatively low, these segments continue to generate stable revenue and remains an important source of income for the company. Astro Fiber falls under the question mark category as it operates in a rapidly growing broadband market but currently has a relatively low market share. This business segment has strong growth potential but requires further investment and strategic expansion. Overall, the BCG matrix suggests that Astro should maintain the profitability of its cash cow segment, invest aggressively in its star segment, and further develop its question mark business to support future growth and long-term competitiveness.
In this slide, we present the result of quantitative strategic value metric or QSPM, which is used to determine the most attractive strategy option for the company. The QSPM evaluates 3 alternative strategies, namely product development, market penetration, and market development. Starting with the strength, the company benefits from strong brand relationship, a large customer base, a diversified portfolio, strong local content capabilities, a well-established digital ecosystem, and strategic partnership. This strength contributes significantly to the product development strategy with 3.47 total attractive score. Moving on the weaknesses, the company faced several challenges including dependence on the Malaysian market, declining traditional pay TV subscribers, high content production, high operational investment requirements, limited international exposure, price sensitivity among customers, and legacy business model challenge. After calculating the total attractiveness score, product development achieved the highest score of 3.47, followed by market penetration with 2.99 and market development with 2.92. Now let's move on to external factors. Starting with these opportunities, the company can benefit from several favorable market conditions. These include increasing demand for streaming service, broad growth in the digital media industry, growing demand for local content, digital advertising opportunities, strategic partnership, increasing internet penetration, AI and data technologies, and strong regional distribution channel. Among these opportunities, product development received the highest attractiveness score because it enables the company to capitalize on emerging trends and changing consumer preferences. Looking at the chart, the company faced challenges such as global competition, piracy, rapid technological change, economic uncertainty, changing consumer habits, rising content production costs, and regulatory change product. The product development strategy helps address these threats by allowing the company to introduce new and differentiated product that create value for customers. Based on the QSPM result, product development achieved the highest total attractiveness score of 3.45, followed by market penetration with 2.58 and market development with 2.53, combining 3.47 in the internal analysis and 3.45 in the external analysis, showing 6.92, demonstrating its strong ability to leverage the company's strength, address weaknesses, capitalize on opportunities, and mitigate threats.
Based on our strategic analysis in Chapter 3, we selected 3 strategies, namely market development, market penetration, and product development to strengthen Astro's competitive position and support its long-term growth. First, market development focuses on expanding Astro's digital streaming services beyond Malaysia. We propose introducing Astro Go and Suka into neighboring countries such as Singapore, Brunei, and Indonesia, where demand for online entertainment continues to grow. Astro can collaborate with local telecommunications companies to offer bundled streaming packages and produce more regional content that appeals to audience across Southeast Asia. This strategy allows Astro to diversify its revenue sources and reduce its dependence on the Malaysian market. The second strategy is market penetration, which aims to increase Astro's market share within Malaysia. To achieve this, Astro should organize digital experience roadshows at universities, shopping malls, and public events. These roadshows allow potential customers to experience Astro Go, Suka, and Astro Fiber through interactive demonstrations and exclusive promotional offers. Astro can also strengthen its digital marketing through social media campaigns, influencer collaboration, referral programs, and loyalty rewards to attract new subscribers while retaining existing customers. The final strategy is product development, which focuses on enhancing Astro's existing products and services. We recommend integrating artificial intelligence or AI into Astro Go and Suka to provide personalized content recommendation based on users' viewing preferences. Astro should also invest in producing more exclusive local content, improve streaming quality, introduce interactive features such as watch party and live voting, and expand compatibility across multiple devices. These improvements will provide customers with a better viewing experience and strengthens Astro's competitiveness against international streaming platforms.
The implementation of the proposed strategy is expected to strengthen Astro's position in the digital entertainment industry and support its long-term growth. First, the market penetration strategy is expected to increase Astro's subscriber base, market share, and brand awareness within Malaysia through roadshow, promotional campaign, and customer engagement activities. This initiative can also improve customer loyalty and retention. Secondly, the market development strategy is expected to expand Astro presence into Singapore, Brunei, and Indonesia through Astro Go and Suka. This expansion can help Astro attract new customers, diversify its revenue stream, and strengthen its regional presence in Southeast Asia. Finally, the product development strategy is expected to enhance customer satisfaction by introducing AI-powered by recommendations, exclusive content, interactive feature, and improved streaming quality. This improvement can increase customer engagement, strengthen loyalty, and provide Astro within a stronger competitive advantage. In conclusion, these strategies are expected to drive subscriber growth, improve customer experience, increase revenue opportunities, and reinforce Astro's position as a leading digital entertainment provider in Malaysia and the Southeast Asia region.